do, I will simply summarize it. I'll summarize it because now you guys have, the notes there. So in talk of real estate, we are looking at real estate is land and any permanent fixtures, on it. So anytime we talk of real estate, we are looking at property. And for us, property is what? Yeah, property is land and any permanent structures or fixtures on it. All right. Could you kindly tell me, ladies and gentlemen, we know that real estate properties, they fall under what we call alternative investments. They fall under what we call alternative investments. You know, we have got the traditional investments where people would want to go and invest in money market funds. They would want to invest in bonds. They would want to invest in shares. Those are the traditional. All right. But now we have this real estate. We have, for example, the cryptocurrencies, etc. We call them alternative investments. Alternative investments. Where are the alternative? You may get at times in this case here, for example, right now, we can see apart from this turmoil happening with this Gen Z thing, which is a very good thing because I'm seeing through it. We shall get, for example, waivers of this affordable housing thing where we are paying money and will never get any house. International disaster, good thing. Of course, that has an effect in the stock exchange. That has an effect in the stock exchange. All right. So, of course, in this case, we expect the share prices here to go down a little bit, just a little bit. It was just a little disturbance. All right. Now, ladies and gentlemen, for land, we know that land, as much as there would be a lot of variations here and there, if you hold on to land in the long term, the appreciation becomes what here? Very high. The land value becomes, in this case here, it increases really at some astronomical rate because it has got an association with the population. You know, like, for example, in the next few years, like 10 years from today, I'm so sure Kenyans will be about 65, 70 million. The land is not increasing. All of us are fighting in this case here for this same resource. So somebody may make an argument that Mwalimu, you've been having in this case here, for example, if you're selling land for the last 4 or 5 years, it has been quite a hell to sell land. Not easy to sell land. Trust you me, that was just a little bubble that, of course, will burst very soon. And at the end of the day, we'll get ourselves selling land crazily. If you have land on very strategic places, land can never depreciate. All right? Land can never depreciate here. Land can only go what here? The value of land can only go up. So then the most important thing, if you look at your syllabus, what are we required to appreciate about this land? What are we required to know about this property thing? We are required here to know about how to value. So in this case, here, valuation of properties. Valuation of properties. Valuation of properties. Real estate properties. We have 3 approaches, and today I would want to do the income approach. The income approach. Under income approach, we have got 2 methods here. One, we have what we call the net operating income method. The net operating income method, NOI method. So we have here the NOI method, the net operating income method. Yeah. What you're supposed to know about this NOI, I would today request you guys to write pretty fast. What you're required to know about this NOI is that NOI is the cash flow based. It is the cash flow. It is the cash flow based operating income. Operating income. It is the cash flow based operating income. Cash flow based operating income. It is the cash flow based operating income. Now, you, my good students, when anybody talks about operating income, what comes to your mind? What is operating income? What is operating income or operating profit? Is there somebody who can tell me something about this? What is operating income? What is operating income? Somebody please give me. Yeah, it is PBIT. It is profit before. It is profit before interest and tax. It is EBIT, yes. It is EBIT. It is earnings before interest and tax. Please, you can write this in full, which is the same as profit before interest and what year? Interest and tax. So remember, this is OE, operating income. But now we are talking of NOI. So NOI, remember, is cash flow based. So it will be profit before interest, depreciation, and the tax. So whenever we talk of NOI, you always know that NOI is profit before interest, depreciation, and the taxation. Profit before interest, depreciation, and tax. So in this case, you can't subtract. You can't subtract, in this case here, depreciation whenever you're getting NOI. Or any impairment. You were told that there was impairment of goodwill. Any intangible expenditure, not like intangible, but any non-cash flow expenditure. Any non-cash flow expenditure, you will always add it back. Non-cash flow expenses will always be added back because NOI is profit before interest, depreciation, taxation. If there are any impairment losses, you can't deduct them. So anything which is non-cash flow based can never be deducted. So for you to understand very well, I want us to look at an example right away. Let's look at an example right away. Let's look at an example right away. Let's look at an example right away, So for example, we have here XYZ property, information on XYZ. All right. So in this case here, we have rental income over 10,000 of 10,000. So we have other incomes. We have other incomes of 2,000. We have in this case here vacancy losses of 6%. Vacancy losses of 6%. They've given us depreciation of the property for a whole year, 3,000. We have interest on a loan that we took to construct the property, for example, 1,500. We have insurance, say 500. 500. We have tax, say 1,000, 1,200, 1,200. That's enough, ladies and gentlemen. So we are required. Number one, you give us NOI. Number two, you give us value of property. You give us value of property if cap rate, they normally call it cap rate. Here we call it cap rate. If cap rate is 10%, you give us a value of property if cap rate is 10%. Cap rate is capitalization rate. Capitalization rate is the same as cost of capital. It is the same as cost of capital. At times they could give you the return on investment. At times they could give you the return on investment. At times they could give you the return on investment like that. So I want to give you guys, great ninjas, 1 minute, you compute for me this NOI. Please, 1 minute, you compute for me this NOI. Abracadabra, compute for me this NOI. I'm so sure somebody will be able to get this NOI pretty fast. NOI is net operating income. I will deduct all expenses except these three. I will deduct all expenses except these three, except interest, except depreciation, except tax. All other expenses I have to deduct from my incomes. So solution, ladies and gentlemen, solution. So solution, what do we have here? So we have rental income. Rental income, 10,000. We have other incomes. So like, for example, we have Sternberg House, where we have RCM physical classes, quite a small space there, but a great place. All right. So in that place, ladies and gentlemen, of course, we pay normal rent to the landlord. And then for you to be able to put billboards outside, you will have to give him some rent here. All right. But now that can't per se be called rent really. So that, of course, will be what we call other incomes. Other incomes. So the landlord, when the landlord in this case is looking at, when the landlord is looking at his income, he'll be looking at the rental income plus the billboard incomes. So plus these other incomes. So we have here rental income, other income. So this gives me 12,000. But remember, you can't collect this. So this is what we call the gross potential. Gross potential rental income. At the end of the day, they call it gross potential for the whole property. For the whole property. You'll be very lucky to have 100% occupancy. You'll be very lucky to have 100% occupancy. Normally, what will happen here, you will have vacancy losses. So we have here vacancy losses. Yeah, these are losses. Yeah, sorry for my handwriting, we shall overcome. Vacancy losses. So the vacancy losses, it is 6% times the gross potential. You know, somebody who is not able to pay, if it's RCM, if you're not able to pay our monthly rent, will we be able to pay the fee for billboards outside there? No. If people are defaulting on the rental, this rent, then automatically even the other incomes will be forfeited like that. So whenever it comes to you guys getting these vacancy losses, you take 6% of the total, of the gross. So 6% of 12,000 gives me how much? So this gives us 720 like that. Very good. Very good. So can I go ahead and subtract depreciation? Can I go ahead and subtract depreciation? No. We can't subtract depreciation here because, of course, that is non-allowable expenditure. It's non-allowable expenditure. Interest the same. We can't subtract interest. It's non-allowable. So this is non-allowable. Non-allowable. Interest is non-allowable. Tax is non-allowable. Tax is non-allowable. The way you do it in your advanced taxation. So in this case here, vacancy losses, that is okay. So I can see the only allowable expenditure that now we have here is insurance. It is insurance. It is insurance. Insurance of how much here, somebody? Insurance of 500. Insurance of 500. So that is it. So you are able to give me the NOI. You are able to give me the NOI here. Is there somebody who can give us this NOI? So it will be 12,000 minus 720 minus 500. Minus 500. Insurance deduct, yes. So 10,780. 10,780 like that. That is the NOI. So what have you learned, ladies and gentlemen? Assuming in this case here, this class was to end here now. And then you go to a workplace and then your immediate supervisor wants to know, like, what have you been studying today in your early morning class? I mean, what have you learned out of this? What is it that you will never forget? What is it that you'll never forget here? You were to close this class like today, and then outside there you get, yeah, Mary Ann, that is the most important thing. Depreciation, interest, and the tax, those are non-allowable in calculations of NOI. Never deduct corporation. Actually, that is the language. Because at times the students will see the property taxes, and then they confuse. This tax, the one that is non-allowable is the corporation tax. Thank you very much, Frida. It is the corporation tax that is what here, non-allowable. Because if, for example, you are to get like property taxes, do you know what property taxes are? Property taxes. Property taxes are not the same as corporation tax. Property taxes are the rates, the rent that you pay to the municipal government, to the county government. So that is very much allowable. Property taxes will be allowed. What we can never allow you to deduct here is what we are calling the corporation tax. That 30% of the total earnings here, we can never allow you to deduct that. But any other form of it, you'll be told insurance and taxes. Don't tell me that I will kill the entire insurance and taxes because it has got a word taxes there. No, it is corporation tax that you are against. It is corporation tax that you are against. Mikali has just joined. Yes. So Mikali, we just had this small illustration here. This small illustration there, which we have been able to do here. So net operating income will be 10,780. So from there, go ahead and give me the value of the property. So we have here value of the property. Value of the property. So value of the property is very good because what you'll do is to capitalize this NOI. Remember this property, we're going to stay with it indefinitely. So whenever we're going to stay with an asset indefinitely, then we shall have to take the cash flow over R. Cash flow over R. Cash flow over R. So we have here our NOI divided by the cap rate. 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 I've told you cap rate is the same as what your cost of capital. So our NOI is 10,780 divided by the cap rate of 0.1. So this one here will end up giving me 10,780 like that. 10,780, 10,780, 10,780, 10,780. So I don't have my past paper, but I remember somewhere August 2023, somewhere in August 2023, they brought this concept, and I mean, very few students in Kenya were able to get this thing. Is there somebody who can look for that past paper and give us that question here? Somebody who can give us this past paper. Cap rate was 1% or 16%. Let me remember here. It's my handwriting, which is very bad. Cap rate is 10%. Cap rate is 10%. I'll try to improve for sure. I'll try to improve. This one is disturbing my students now. Cap rate is 10%. Cap rate is 10%. All right. Thank you so much. So I believe there is somebody who is going out of their way to try to help us get that question. It must have been on the August sitting, August 2023 sitting. And this semester, of course, if I'm the examiner, if I become an examiner, if somebody tells me to examine, I will examine this concept, and this is how I'll throw students under the bus. To throw students under the bus, this is what I will do. I'll give these students here like XYZ Limited, as a subsidiary give me this answer, gives me that question, XYZ Limited, I'll give them something like this. I will come and give them profit after tax, I'll give them 10 million. I'll give them depreciation, I'll give them 2 million. I will give them interest, I'll give them interest, interest over how much now? I'll give them interest over $1 million, of $1 million. Then I'll come and give them tax, I will give them tax of 2.5 million. I will give them insurance, 500,000. I will give them vacancy losses, 200,000. And then I will come and tell them if cap rate equals 10%, if cap rate equals 10%, calculate value of the property. Calculate value of property. Calculate value of property. Calculate value of the property. Thank you very much. Thank you very much. I can see somebody has given me that. So if cap rate is 10%, calculate value of the property. If I was given a chance of examining, and really, if I feel that I would want to throw students under the bus is then CASNEB success, right? So you get them out of the bus, throw them under the bus. This is how they set it. And they give so many marks, give even like 6 marks for this. I'm so sure I'll be able to catch somebody. Yeah, PAT is 10 million. PAT is 10 million. Aaron, P Chumba, PAT is 10 million. Vacancy losses, you see, for example, if you have your gross potential income for a whole building, 10 million, you know, at times you may not be having like 100% occupancy, all right? So that is the opportunity cost of not having, in this case here, like your house is occupied. Your house are unoccupied. So like in this case here, this is the rental income which will not be paid. The rental income that will not be paid, rental income which will not be paid is this amount. Mike says 148 million. So the question is, as Aaron is really struggling to help us there, the question here is, how do I drive this PAT back to NOI? How do I drive it back to NOI? It is now by adding back. We add back those non-allowable expenses. You add back the non-allowable expenses. You add them back. You add back the non-allowable expenses. Add them back. All the non-allowable expenses. The good ones, leave them out. The good ones, leave them out. You see, the moment I'm able to remember here that NOI is PBIDT, PB, profit before tax. So you see, I don't want it after tax. I want it before tax. So I'm adding things back. I'm adding things back. I'm adding things back. I'm adding things back. So in this case here, come and give us the cash flow NOI. So the cash flow NOI, here it will be PAT plus tax, plus interest, plus depreciation, those three. Because now I have to add back. Because you guys are the ones who told me that NOI is PBIT, the original one, profit before interest and tax, but now and depreciation. So these three, interest, tax, and depreciation, are unallowable. We add them back like that. So in that case, ladies and gentlemen, NOI will be equal to PAT, which is 10 million, plus tax, which is 2.5 million, plus interest, which is 1 million. So PAT is 10 million, plus tax of 2.5 million, and then plus interest of 1 million, then plus depreciation of 2 million. 2 million, which will end up giving me what figure, ladies and gentlemen, here? This one will end up giving me what figure, ladies and gentlemen, here? $15.5 million. So this is 15.5 million, and therefore value of property equals NOI over the cap rate. Equals NOI over the cap rate. So the NOI, we already have the NOI now. We already have the NOI. The NOI is 15.5 million divided by the cap rate, of 10%, which is the same as 0.1. That is how those ninjas got to 155. Mike, I've never seen you not getting a question in class. Where did you mess? Where did you mess, Mike? What happened today? Is there something you, or is there somebody, apart from Mike, I also saw some other ninjas who got it wrong. Is there somebody who took this part and then subtracted the good ones? You see, Mike, thank you for bringing that up. But Mike, you're a great accountant. You know, for them to have gotten this PAT, what does it mean? Profit of tax is the last thing. For them to have gotten PAT, they subtracted everything. They subtracted insurance. They have already subtracted depreciation. They have subtracted even tax. They have subtracted everything. But now I'm coming and asking myself now here, when I want to get NOI, there are things that accountant ought not to have subtracted. There are things he should not have subtracted. So if I start subtracting again, Mike Insurance, honestly, from PAT, I will be double counting. I'll be double counting. Great. Already that has been deducted. I know it's Mike alone. I'm so sure most of us have learned from that explanation. I'm so sure most of us have learned something there. All right. So that gives us 155 million. And you know, ladies and gentlemen, if, for example, I even want, you know, at times these examiners we look at, it's very sad. It's very sad. At times we ask ourselves, how can we get, you know, like in this paper, AFM, we can never allow, we can never allow more than this. It used to be 1,850. But nowadays we have added a little bit. We can never allow more than this to pass. Maximum in the whole of East Africa, maximum. I don't know whether this is fair or unfair, and not to go to occupy CASNEP. You know, may get somebody now telling me, we shall occupy CASNEP. No, no, no. We can never allow more than this. And now, if you're given this kind of then a target, you must ask yourself, out of about 10,000 guys who are sitting for this paper, how do I ensure that I throw 8,000 under the bus? How do I throw 8,000 and under the bus? It's very easy. You come up with tactics here and there. So for example, I could easily come and tell them PAT is 7 million or 14 million. PAT is 14 million. Then we have tax of 30%, tax of 30%, tax of 30%. Then we have, in this case here, interest say of 2 million. Then we have depreciation of 1 million, depreciation of 1 million, depreciation of 1 million, depreciation of 1 million. All right. Then I have, of course, so I can just leave it there, And then what I'll do, I'll now come and tell them, in this case here, question required, calculate NOI. Calculate NOI. And then number 2, I'll come here, I'll make life very difficult for these young people. Such that if, for example, it is a lady who had gone to, the exam room with some very good makeups, very good high-heeled shoes, I'll ensure that this lady, by the time she's walking out of that exam room, makeup, hata high-heeled shoes, anaweza akatembea na mkono amebe, yani hakuna nguvu ya kanyaga iko wapi. So then what I'll do, I'll come here and ask this person here to calculate, in this case here, to calculate value of the property, value of property if the return or from a comparable building that was sold, that was recently sold at what year? Kenya shillings 10 million, is 2 million. Is Kenya shillings 2 million. So calculate NOI, net operating income. And then number 2, calculate value over the property if the return from some comparable building that was recently sold at Kenya shillings 10 million is 2 million Kenya shillings. 2 million Kenya shillings. So first of all, let's ensure that everybody has been able to write here because of my handwriting, great handwriting. So I'm reading again. Calculate value of this property if the return from a comparable building that was recently sold at Kenya shillings 10 million is Kenya shillings 2 million. So is there somebody who has been able to write, first of all, up to here? Have we finished writing? Maybe this gentleman came in a little bit late. Gekonyo. Remember Gekonyo, when they got this PAT Gekonyo, you are an accountant. I would want you to take this few minutes here to think out. How do they get this profit? You know, profit after tax is the bottom line, is the figure that we have down here. How do they arrive at PAT? To arrive at PAT, they must have deducted all expenses. They must have deducted, in this case here, insurance from something there. They must have deducted all these were deducted to arrive at PAT. But now we are coming in this case here as an evaluator and asking ourselves, I mean, we don't want PAT. We want NOI. NOI, there are those 3 expenses which are unallowable, which this guy ought not to have deducted. So what do? We add them back. So you can't subtract again insurance because that will be double counting. Maybe if you watch the video later on, you would understand what I mean. All right. Tobias is saying 70 million. Tobias has already given me the answer. Tobias has given me the answer there. Let's see. Let's see who is able to confirm his 70 million value. Who is able to confirm his 70 million value? There's a student some time back who told me that, Mwalimu, that example of yours of ladies on makeup is inappropriate. Is inappropriate. Is inappropriate. So that lady, of course, after exams, he called me back and told me, Mwalimu, you know what? I felt exactly what you told me, what you told us. I mean, the paper was very bad. The paper was very bad. Especially if you don't keep on studying. You know, if you want this paper to be easy on you, is to study the things that I give you, the things that we give you in class, especially the things that we give you in class. Just keep on doing those things severally. You'll thank me. You'll thank me. Ama zile viatu, kuna viatu zitangwa namna gani hizi? Crocs ama clocks. Simple. You walk simple. You walk simple. You walk simple. This is very good class. Students are giving me different answers, which is really good. Give me your answer. Give me your answer. Or you can go there with the 2 pairs of shoes, one high-heeled, which you can fly with once you finish your exam and it is good. And then, of course, another one now, ground. So, Noi, number 2, Leo. So we have here calculate value of property if the return from a comparable building, that was recently sold for Kenya shillings 10 million. That was recently sold for Kenya shillings 10 million is Kenya shillings 2 million, Leo. Aaron is asking Mwalimu, where is the cap rate? Where is the cap rate, Mwalimu? So Aaron is wale wenye kumwaga. Where Aaron ingekuwa nimekurusha chini ya bus straight away. Chini ya bus straight away. 115. Yeah, this is very good. This is a very good morning. When I see students in this case struggling to give me different answers, that is very good. That's very good. So allow Mwalimu to do this one pretty fast. Allow Mwalimu to do this one here pretty fast. So we have here solution. This is a bit tricky. You see, you can't say that this tax is 30% of this because it's supposed to be 30% of PBT. Let me try to simplify this. So this is PBT that I don't know. Call it X. And then we have here less tax of 30%, 0.3 times X like that, which gives me 0.3X. So less here. So I'm able to get my PAT. So my PAT here will be 0.7 what here because I've taken this minus this, 0.7X. But this PAT is what we have as what here is what we have as 14 million. This PAT is what we have as 14 million. So this 0.7X is my 14 million. This is my 14 million. Therefore, X will be equal to 14 million divided by 0.7. X will be 14 million divided by 0.7. X will be 14 million divided by 0.7, which gives me 20 million. And yet I want taxation. Do you know tax? Are you able to remember that tax is 0.3X? Are you able to remember that tax is 0.3X? Are you able to remember that tax is 0.3X? Tax is 0.3X, which will be 0.3 times 20 million, which will give me 6 million. Is there somebody who was able to get, of course, you may have used a different method, but is there somebody who was able to get something like that somewhere? Is there somebody who was able to get something like that somewhere? Is there anybody who was thrown under the bus right away from this? How we have done? Is there somebody who feels that, Mwalimu, this one, I was a little bit shaken and thrown under the bus? Yeah, I will repeat. I will repeat. Okay, great. Totally confused. Great. I'm good now. I'm good now. Now, you guys, perhaps you're not practicing. Perhaps you guys are not practicing. You're not practicing. You're not practicing accounting at your workplace. What I'm saying is that you guys may not be practicing accounting at your workplaces. You're not practicing accounting at your workplaces. Please try to know how to come up with that. Even if you're not doing accounting, just get some information. Try to prepare a profit and loss account. Because you see, this is 30%. 30%. And we know that PAT, how do we get PAT? How do we get PAT? To get profit after tax, normally we take profit before tax, and then we less what here? We less tax. Isn't it? Anytime they want us to get PAT, we take profit before tax minus tax. Minus tax. All right? So if I understand this, then I'll be able to say very fast that this PAT will be the same as what here? Profit before tax minus, we know tax is 30%. But 30% of what? 30% of this. 30% of PBT. 30% of PBT. So then my PAT here will be equal to my PBT minus 0.3 PBT. So my PAT will be equal to 0.7 if you subtract this 0.7 PBT. That's PAT, 0.7 of PBT. And fortunately, we have this PAT. We have this PAT of what here? Of 14 million. Why I'm saying that most of you perhaps could not be doing this thing practically, I'm so sure there must be somebody who took tax as 30% of this 14 million. 30% of this 14 million, which will be very, very sad. Very, very sad. So you see PAT is 0.7 of PBT, profit before tax, which is 14 million. And therefore, what is profit before tax? It will be 14 million divided by 0.7, which will end up giving me what here? 20 million. 20 million. And of course, what I'm interested in is the tax bit of it. The tax is 30%. 30% of PBT of 20 million. Tax is 30% of 20 million. 20%, 30% of 20 million, which will end up giving me what figure? Somebody here? 6 million. Now, the moment you've gotten this, now you can calculate NOI. How do we get NOI in this scenario? This is the PAT, and I would want to add back the non-allowables. Now you'll be able to understand. So in this case here, PAT, please, PAT, once it is at PAT, you can't subtract anything again, because PAT, they have removed everything. PAT is my bottom line, is what I have down there. I can't subtract, not unless now I'm giving out dividends. You can't tell me that, Mwalimu, now you have PAT subtract. No. Subtract is whatever, even if they gave me anything which is allowable, already they have subtracted. So anytime they give me PAT, to get this NOI, what I will do, I will take the PAT, I add the disallowables, I add the non-allowables. And the non-allowables, like in this case here, is tax, it is depreciation, it is interest. Those are the non-allowables for me to be able to get now the PBIT and the D. So the PAT, they have given me 14 million here. So this is 14 million. The tax they have given me tax here is 6 million. Depreciation here is 1 million. Interest is 2 million. Interest is 2 million. Interest is 2 million. So is there somebody who is able to give me now this NOI? Joyce, you can't be totally confused. Joyce, you must be that now, in that group of students that I'm saying you're not practicing accounting, which is still good, but I mean, this is not very hard. This is not very hard, not very hard. Trust you me. If you take your time later on, you'll be able to understand it. It's not hard. 23. Okay, great. Yeah. I was worried. This is not hard. Trust you me. It's not hard. It's not hard. It's not hard. Yeah. Now from there, first of all, is there any student who was able to get this NOI of 23? Is there any student who was able to get this NOI of 23? So Joy, Mary Ann, only 2. 2. Then I would have thrown so many students under the bus. Mwikali is a truthful person. Mwikali is our deputy president. Truthful man. Truthful lady. Now, you see, the cap rate has not been given. So in this case here, we shall calculate what we call ROI. ROI. The cap rate has not been given, so I shall calculate ROI. ROI is return on investment, right there in full. ROI is return on investment. ROI is return on investment, return on investment, return on investment. So how do I get this return on investment? So of course, I will take the returns given, the returns I get. This could be operating profit, whatever. The returns I get, I divide this by my investment. I divide this by my investment. As we shall be seeing later on, this is the same as what we call capital employed. And this investment can at times, in this case here, be the sales price. Because I mean, my investment, if I'm buying this property, my investment will be the selling price of the property. All right. So they're telling you that there is a comparable property, which in this case here was sold the other day for 10. So they've already given us the selling price. They've given us the selling price of this property. There is a comparable property. So they've given us the selling price they have told us is 10 million. The selling price is 10 million. And then the return, they give us the return for that comparable property. They give us the return for that comparable property, which was what here, somebody? They gave us a return from that 2 million. They gave us a return as 2 million. So are you able to give me this ROI? Are you able to give me this ROI? So the ROI here will be 20%, 0.2, which is the same as 20%. The ROI here will be 20%. The ROI here will be 20%. The ROI here will be 20%. So they've given you a comparable ROI. So I should be able to use this comparable ROI because it's comparable. I should be able to use this comparable ROI as my cost of capital, as my cap rate, because even these shareholders of this property that I'm valuing here, I mean, they'll ask for a similar return. So this automatically is your cap rate. This automatically is your cap rate. This automatically is your cap rate. And therefore, value of the property. Value of the property now will be the ROI that you guys gave me of 23 million divided by 0.2 like that. 23 million divided by 0. And there is somebody who got that 100 and something. There is somebody who got that figure. There is somebody who got that figure. There is somebody who got that figure, which is really Mulerie. That must be a very good ninja. That must be very good. But the thing is, are we now comfortable, all of us? Are we comfortable, all of us? I mean, are we comfortable, all of us, regarding now how this has been, especially that PAT thing, the PAT thing? Thank you so much. Thank you so much. Thank you so much. And it's like I've exhausted all methods. I mean, even if I was to give you a mock, it's like I've exhausted all methods that I would use to confuse you. All methods that I would use to confuse you. Which other method in this case here can I use to confuse my students here? Which other method can I use to confuse my students here? It's very easy. I mean, there are so many ways you can tricks you can use to comparable properties. Tell them that in the recent past, in the industry, there are 2 comparable properties that we have sold in the recent past. So property 1 return, property 2 in this case investment, property 2 return, property 2 investment. So in that case here, what should you do? You calculate ROI for each, and then you say for the industry, you're going to take the average of the 2. So the cap rate will be the average of the 2. And that concept, we tested that concept in August. Go to that August 2023 for me to make that point. Get home. Go to this August. Are you able in this case here to attach this question here, Mary Ann? Yeah, Tobias Kebati average. Mary Ann, are you able to attach this question? Apparently, I don't have the question here. Are you able to attach it here pretty fast? You can take a screenshot on there. Mary Ann is normally a fast ninja. This Mary Ann is a fast ninja. As Eric Onyango told me, nimezeeka. I'm so sure Mary Ann hajazeeka bado. Some students had given me that question up there. Let me just check. I'm so sure. Mary Ann ni mdogo bado. I can't seem to get that. Students had given me the question. Yeah, August 2023, question number 3B. Question number 3B. August 2023, question number 3B. So are you able to attach it here very fast? Are you able to attach it? You know, right now, everybody really, Eric hujaniambia poa, Eric hajaniambia, you know, everybody now wants to feel like Generation Z. Everybody wants to feel like Generation Z. Utanitaje mzee asubuhi namna hii? Where Eric, you owe me. Eric, you owe me. Not an apology, but a meal in a good restaurant. All of us now, we are Generation Z. We are proud of what they are doing. Thank you very much, Mary. We shall overcome. Now, as I download this, I would want to see whether there is any ninja senior. Yes, thank you, Lillian. Lillian, I see now you know good descriptions here. Lost generation. No. Senior Gen Z. All right. So then I hope there is someone who's doing the question. All right. Great. So the following information relates to an office complex, gross potential income, insurance and taxes, utilities, repairs and maintenance, depreciation, interest on proposed financing. Vacancy and collection losses are estimated at 6%. Check this. Recently, 2 buildings have been sold in the same locality. The first building had a net operating income of 1.5 and was sold for 12 million. The second building had a net operating income of 675 and was sold for 4.8. So number one, they want us to give them the NOI for the office complex. The NOI for the office complex. The NOI for the office complex. NOI for the office complex. 4 marks. The appraised price of the office complex using the income approach. I can see a chart here. Great. I can see, Eric, you're also, you must be a junior Z. You must be a junior Z. As I'm a senior Z, you must be a junior Z. You must be a junior Z. All right. So the gentleman here, this is quite a simple one. I can see NOI seems Mary Ann has given me a different one. Leo 76 different. I like when I get students giving me different answers because I know there is learning taking place. There's learning taking place. There is learning taking place. So we start with gross potential rental income. So gross income. So gross, please give me the figures. Give me the figures instead of me going back to my screen there. I even know what I'll do. I even know what I'll do. I'm a senior Z. Oh, international. I have to wait for your figures. I have to wait for your figures. 864, 84.9. No. Now, thank you very much. Now give me the figures. The gross potential rental income is how much? The gross potential rental income is how much? 1050,000. 1050,000. Straight away, I less the vacancy losses. Less vacancy losses of 6%, isn't it? Of 1050. Of 1050,000. 1050,000, which will end up giving me what figure? Somebody here. Vacancy losses of 6%, 63,000. Then we have insurance and tax. We less this one. Insurance and tax. Don't be here with this word tax. This word tax can easily make you to omit it, but these are property taxes. Those ones have to be deducted. So 264. Whenever you see tax with anything, the only tax that we cannot subtract is the corporation tax. The only tax that we can't subtract is the corporation tax. So we have utilities. Are you able to see the utilities? Are you able to see the utilities? For insurance and taxes is 78,000. Sorry for that. 78,000. Sorry for that. Okay. Are you able to see the utilities? 54,000. So utilities, 54,000. 54,000. 54,000. Do we have any other expenditure to deduct, or that is it? Do we have any other expenditure to deduct, or is that it? Repairs. Repairs ambazo ni ngapi? 69,000. 69,000. I think that is the last one. Don't subtract depreciation. Don't subtract interest. Don't subtract depreciation. Don't subtract interest. Don't subtract corporation tax. So they come and give me the NOE here. Come and give me the NOE. Give me the NOE. 786,000. Now, these ninjas like Mary Ann today, you also got it wrong, and that's life. Life, you know, life does not need perfection. Don't ever go for perfectionism. All right? So where did you go wrong, Mary Ann? Where did you go wrong? Where did you go wrong? Or you did vacancy losses after lessing all the others. You see, vacancy is normally on the gross. Vacancy loss is on the gross. Is on the gross. All right. Thank you so much. Thank you so much. And then now in terms of cap rate, we have 2 apartments that sold the other day. We start with ROI 1. Return of investment 1. So are you able to see the operating profit for the first one? Operating profit for the first one. Please give me the figure. Operating profit for the first one. Are you able to see it? 1.5 million, right? I hope everybody's able to see that. So 1.5 million, and this property was selling at how much? What is the selling price? Because the selling price is the investment. The selling price is the investment. 12 million. 12 million like that. Times 100. So is there a ninja that was able to get this? Is there a ninja that was able to get this? 12.5 million. So this is 12.5%, I mean. And then we have another property. Now this time around, we should introduce 3 properties. So the aim here for the examiner, the aim of the examiner is to confuse these students. Yeah. I mean, a good examiner should be able to set a paper, which of course is within the syllabus. But because of the confusions in between, a student sometimes in this case, I should read a question until they feel like it's a tongue twister. Yeah, if can't I, a tie. If can't I, and untie a tie. Why can't I tie and untie a tie? As can't I, and untie a tie. Yeah, just an easy question, but lots of confusions inside. Lots of confusions inside. So in this case here, are you able to tell me in this case here, what is the profit here for property 2? Profit for property 2. Profit for property 2. 675,000. 675,000 divided by sales price of property 2. 4.8 million divided by 4.8 million times 100. So then this one here will end up giving me what here? 14.06. Thank you very much. And because there are two properties, therefore my cap rate will be equal to the average. My cap rate will be equal to the average. So this is 12.5% plus 14.06%. You divide this by 2. You divide this by 2. You divide this by 2. Which will end up giving us 13.28, 13.55, 13.28. Who's telling us the truth? I don't know. 13.28%. But this is 14.06. So 13.28%. 13.28%. And therefore value of property, will be 786,000. You divide this by 13.28%. You divide this by 13.28%. $59,18,675. $59,18,675. Now there is somebody who has not understood in this case here, where I'm telling you like these confusions, which the examiners can give you. It's not that I'm a sadist, because I can see somebody telling me, well, you're a sadist. I can't be a sadist. I'm a gentleman, trust you me. I just want you to get those tricky areas, the tricks. It's called tips and tricks. For you to know how would you want me to teach you like direct things like that just without mentioning them? And then you come to, no. I have to teach you tips and tricks. Tips and tricks. I must teach you that. Tips and tricks. November 2019, question 4B. November 2019, question 4B. November 2019, question number 4, boy. November 2019, question number 4, boy. Once you guys are able to get that question, kindly say, yes, you have gotten it. Great. Great. So you're told here property A and the property B are categorized under the real estate category. Property A is all equity financed, while property B is financed partly using debt and partly by equity finance. Both properties generated operating profit of 41,245,900 annually. This is expected to remain constant each year in perpetuity. Unlike property A, which is wholly equity financed, property B is financed partly by equity and partly by 10% debt of 215 million. The cost of equity is 12% for both properties, and there are no corporation taxes. Each unit of debt is trading at par. They want us to give them the current value of each property, not using NOI approach. Not using NOI approach. So this is the second one. Remember, NOI was under net income. Let me just make things simple here. Under net income, or rather under income approach, under income approach, we have NOI, that's number one. And then number two, we have NI. NI is net income. NI is net income. Net income. So in this case here, NI is net income. So if I were you, I would have titled this with NI. I would have written up the net income approach. Net income approach. So on a net income approach, it will be very important for us to appreciate that net income belongs to who? Net income belongs to equity holders, belongs to equity holders, belongs to equity holders. Net income belongs to equity holders. Remember, net income is the same as PAT. It's the same as PAT. It belongs to equity holders. It belongs to equity holders. Remember, in our case, we don't have preference shareholders. So whenever we get PAT, automatically that belongs to equity who? Equity holders. This belongs to equity holders. And therefore, we use it. We use it to value equity. To value equity. To value equity. i.e. VE. VE. We use it to value equity. We use it to value equity. So what we are saying is that value of equity will be net income, over KE. Value of equity will be net income over KE. Value of equity will be net income over KE. So I only have 5 minutes just to summarize. We are saying here that value of equity will be equal to EBIT minus interest. EBIT minus interest over KE. This is a very important formula. Very important formula that I would want you guys to underscore. Very important formula that I would want you guys to underscore. Which question is this? We are doing November 2019, question 4B. November 2019, question number 4B. November 2019, question number 4B. So you must have done this topic with teacher David, CPA David. You must have done this with CPA David. And of course, you must have learned that net income approach assumes zero taxes. Assumes zero taxes. Assumes a zero tax environment. No taxes. So don't tell me that Mwalimu come and put outside here 1 minus t. No, 1 minus t because tax is 0. So 1 minus 0 is 1. So basically value of equity will be EBIT minus interest. That is the net income. EBIT minus interest over KE. Over KE. And fortunately, this question, they told us in this question down there that the tax is 0. They told us there. They told us in this question. They told us in this question. They told us in this question. And there are no corporation taxes. They told us before required. No corporation taxes. Or you haven't yet done this. You haven't yet done this. Okay, okay. Then he must have gone to like a portfolio or something. Okay, no worries. No worries. No worries. All right. So then we have 2 properties. Let's get in this case here the value of equity of property 1. So we have here value of equity of property A. Property A. Remember property A, 0 debt, no debt, 0 debt, and therefore 0 interest. Property A is all equity financed. Is all equity financed. It doesn't have any debt. So it's 0 debt and therefore 0 interest. So then come here and give me value of equity. Give me value of equity. Is there somebody who is able to see EBIT here? Is there anybody who has a value or rather EBIT? EBIT for property A, please. I only have 1 minute. I only have 1 minute. Oh yeah. 4124, 4124, 4124, 5900. 5900 minus 0. Minus 0 because interest is 0. And have these ninjas given me the cost of equity? Have these ninjas given me the cost of equity? Cost of equity, Mike, thank you very much. It is 12%, which is the same as 0.12. So then what is the value of equity of property A? I mean, these are free marks. I've never understood why people fail in advanced AFM. Mary Ann is asking whether is that EBIT not like, I mean, it should be like, why should we not? Why should we not? Why should we not? So both properties generated the EBIT of 41 to 45, 900 annually. You can't divide. I'm so sure it could be language issues, but normally when you come to this topic, you'll see they'll be writing like for you EBIT. They want to prove that EBITs are the same, but at the end of the day, the value of the properties will be different. So EBIT will be, that is for each property. That is for each property. It is for each property. All right, we must work them out separately. So can you then kindly go ahead and give me value of equity? Go ahead and give me value of equity. Yeah, they mean each year. So it is 343, 343, 343, 71, 71, 58, 33. So then when we come in our next class, we shall be able to do what here? We shall be able to get value of equity of property B, and then we transform them to what we call total values. Total values. Total values. What's your maneno ya Tobias? Your maneno ya target numbers of students to pass stroke fail, hiyo ni mambo baya, because all of us in this case here we are passing. But I would want you guys to put the same effort. You see the same effort we are putting, like I can see in AFR, like group consolidation, you guys have really put in lots of efforts. Like I gave out some assignment and I got very good answers. I mean, very good answers from questions, answers which are balancing. And somebody tells me that Mwalimu was able to do this in 37 minutes. That's very good. So the same effort we're putting in AFR here now. Yeah. Thank you so much. See you. Is it later in the day? Later in the day. Thank you so much. Bye. Bye. We shall overcome.